Welcome back to another episode of Compliance Insiders. I'm your host, Roger Fendelman. Thank you again for joining us this week. Joining me today is my stellar panel of guests, Felicia Flea Bowers, the Chief Compliance Officer of Homeowners Financial Group, Jerra Ryan, SVP of Compliance at SWBC Mortgage, also head of QC, Paula Leber, VP of Compliance and Licensing at CMG Financial, and last but not least, Marty Allred. You can see I'm reading this. I don't know why. I've known you guys for years. CCO, American Pacific Mortgage. So it really is going to be a lightning round because we've been talking about issues that crop up. They are not the priority necessarily today because we're still in the middle of coronavirus, COVID-19, the pandemic. We just had a conference last week talking about how people are coping and getting by and dealing with the issues and getting people to work remote. But as all of you have said repeatedly, compliance still goes on. It doesn't stop just because of the pandemic. There are still the same issues that there were before. So let's talk about a few of them today. We're going to do something kind of like, it just seems like this. And I would say maybe a third of you know what this is and 2/3 of you are probably on the younger side and like, is that what my grandparents used to watch? Probably, yeah, it is. It's the Hollywood Squares. So we're going to do compliance squares, but not for long because it's pretty cheesy. So this is going to be a free-for-all. Let's just talk through some of these issues because I think what's interesting about them is in a lot of cases, there's no one right answer to the problem. It's more or less what your risk tolerance is as a company and what your needs are. So that's what's going to make this a lot of fun. Let's get started. Let's talk about lightning round issue number 1, credit repair services. Yes or no?
Caution.
No. No. Double no.
Okay. Why?
Well, I think, in some areas there are licensing requirements. And I think, that's just one logistic part of it. But I think there could be an inherent conflict of interest there. I understand why an LO, doesn't want to lose a consumer by sending them to a separate entity to take care of that, worried that they're potentially not going to come back. But I think that there are just some inherent conflicts of interest that we need to have some separation around.
Maybe so, but they're very popular. They're used a lot, aren't they?
They are, and absolutely, they can benefit the consumer, but I think, loan officers should just concentrate on being able to get that loan and get that borrower qualified, when that actually happens. Time that there needs to be work and repair, that could be done by, somebody who's an expertise in that particular field.
I think the biggest risk with credit repair is really how much those credit repair companies solicit our LOs, because they need our LOs for the business. And unfortunately, more importantly, they need our LOs for the credit report. And I think that part of what happens is, whether you're on the production side, ops side, compliance side, you need to have an understanding of how it actually works. And those credit repair companies, the vast majority of them do not have permissible purpose to request credit. And they want to work off of a mortgage credit report that has a credit score. And so they ask our LOs for copies of that credit report. Send me your borrower's credit report and I'll work off of that and get them repaired. The LOs don't understand the requirements under credit repair organizations and that they're not supposed to charge the borrower for the credit repair until they have, succeeded. And they don't understand that part of what those organizations are doing, or many of these credit repair companies are doing, is they may not charge for the credit repair itself, but they're charging for their lovely book, or their program, or their flyers, but they're not charging for the credit repair. But is that book really worth $995?
Well, Paula and Flea, now we've got an issue because you have an agreement signed with the credit reporting agencies that say you're not going to be sharing their borrower's credit report with any third parties. You also have potential privacy concerns because even if the borrower tells the loan officer, sure, you can do that, the lender's always on the hook, and the borrower, of course, 3 years from now might not remember that. So what happens with that? Now, what do we do?
So I can tell you what we've done internally, and that is we have a group of 3 individuals that work with the consumer to improve their credit scores. We don't charge them any fees. We don't charge them for the credit reports. And we walk them through the process of what they need to do to send letters to the creditors, when they're contesting items, what they can pay off, what they can't pay off. We have what-if scenarios running all the time to help them improve their scores. I think the industry as a whole is predatory. It's preying on the vulnerable people who want to get into a home, who have lower than allowed credit scores. And I just truly think it's a predatory industry. I don't like it at all, which is why we launched an internal service.
Flea, I love that. That is such a good idea. We have flyers and instructions to help a borrower, because it's a very direct process for how to improve your credit. So we can advise them on that, but it's great to have staff that's set to help them specifically. That's a great idea.
Yeah, I like the fact that you have that separated. So again, the loan officers can concentrate on the loan process itself and not be detracted from, that's a lot of work to do credit repair and to really assist borrowers, which is a great benefit to them, but I think it's good to separate that. So that's a great idea to have an in-house staff or department that can do that.
Flea, is it a cost center for you, or is it actually something that you benefit from financially? Does it pay for itself?
It's a cost center, but we also benefit from it. I mean, there's a certain portion of that loan closing, of every loan closing, that goes into the bucket to fuel this department because it's used quite a bit. There are 3 individuals. They are licensed loan originators. They do not receive compensation off of that loan because in most states, paying a referral fee for something like that is illegal, or paying a referral fee to someone else, is illegal. So they just have a different compensation structure. They are well-seasoned loan originators who don't want to be out in the market calling on realtors. And so it's a win-win situation for us. And they really enjoy helping the consumer improve their scores and get into a home. So, and that helps too.
That's great. So, Jerra, how does that make you feel?
Well, I knew that these professionals would have it all together in their organization. I'm fully like you. I think that the idea of credit repair is good. I think the way that it's executed is predatory, or at least borderline predatory. There are so many ways that the consumer can do it themselves. There are so many ways that you can either do what you guys have done with, your SWAT team, your credit SWAT team, right? But the LOs, there's so much they can do with that credit report themselves, and they can distinguish themselves as the experts on having that knowledge. But when you refer your customers, when you say, look, just go to annualcreditreport.com, there are actually counselors and people available there to help that consumer for free. And in many states, there's an expediency, they will act more promptly if you are applying for mortgage credit, and they will help you do a lot of things that you will pay some of these other organizations a lot of money to do for you. So I think it's a good decision. But are we going to have a voting poll here for our listeners, like thumbs up, thumbs down from the voters, or our audience? What are we doing here?
No, but we should. But to your point, the other day when we were talking about this issue, it can be a big deal that the way it's typically done, not the way Flea's company is handling it, which is great, is that the LOs take it upon themselves, and like you said, they work directly with the credit repair company, and they will hand the borrower's credit report directly to, presumably with the borrower's or applicant's permission, hand that over to the credit repair organization who's going to charge them a lot of money, take several months to work on it. And that puts you as a lender at risk, doesn't it?
Yes, it does. Makes us a provider of credit now, and That's not what my agreements with each of our credit report providers say that we are, or with the bureau. I think the other thing that, you know, it might be important for some of our LOs to know and to understand is that credit repair is actually a hot button for the credit bureaus themselves and for our providers, because they are audited for compliance with credit repair, et cetera. And so there are frequently prohibitions within your agreements and or from the bureaus themselves of working with or promoting credit repair. And several years ago, we were vetting different social media monitoring platforms. And, you know, one of the advantages of doing that is you get, you know, 15 to 30 days of free monitoring to see how their service works. And one of those services picked up that one of my LOs on a Sunday morning at like 10 a.m. had just posted a YouTube video with his best credit repair partner. And, you know, the alert came in from that monitoring service, hey, you may want to take a look at this and have him take it down. Equifax, TransUnion, and Experian tend to watch and track for things like this. And sure enough, Monday morning, we had a letter from Equifax that if he did not remove it and did not quit promoting credit repair on his website, he would lose access to the Bureau for 30 days. How long can they stay in business if they don't have access for 30 days?
So what we have to do going forward is we have to look at our agreements with, if your LOs are doing this, look at our agreements with the credit reporting agencies and make sure that that's not an issue. If it is, you need to go a different route and perhaps following Flea's lead, but maybe not, because maybe I think, Flea, your company might have a competitive advantage. So you might want to hold on to that. But anyway, something to think about. I think it's really interesting, and we should come back and visit that again. Lightning round issue number 2, trigger leads. So a borrower comes to lender X and makes application for a mortgage. There's a soft pull or a hard pull depending on the status of, you know, what stage they're at. And that data is then sold by the credit reporting agencies, our good friends, to other lenders who then start to reach out. All right, so here we go, team. Is it good or bad?
Bad. Definitely bad.
I know, right?
I'm with you. I'm kind of flatline.
I know where all you're going.
It's
It's
a
good when it
double-edged
benefits
sword.
you. It's bad when it benefits your competitor, right?
Oh, of course. Yeah.
I think our LOs, I think our LOs hate it, and I'll get emails from them saying, "How is this even legal?" You know. But on the flip side, you got to remember, if you're servicing, you're probably doing some sort of trigger monitoring as well. So you can't just come out and say this is the worst thing ever and no one should ever do it if you're actually doing it on your own servicing pipeline. But it's a tough gig, and I know a lot of states have tried to run legislation to prohibit the sale of trigger leads. They may have succeeded, may not have. I know that federally there was a push or a bill introduced earlier this year, I believe in the Senate, it could have been in the House, to address the issue. But, you know, the way that the credit bureaus promote it and the credit companies promote it is, hey, this is good for the consumer because they're actively shopping. Now they will know who else is offering something and they can be making their informed choices, which is what our LOs hate.
They also say it's good for the consumer because what's good for them is good for the consumer, and they make money off of it too. So of course they're going to say that.
Well, and the consumer has, you know, things that they can do to not even be on those lists. They can file with the do not call registry. They can do that, you know, file with the no direct mail registry. There's things that the consumer can do. So there's that, but there's, from the sales side, you know, there's a race to the consumer to try to know as soon as they're even thinking, before they even are thinking about refinancing or purchasing a home, there's a race to the consumer. So from a sales standpoint, it's good. I think from a compliance standpoint, you just have to make sure that you're meeting the firm offer of credit requirements for pre-screen for credit monitoring. But, you know, as long as you're adhering to all of those rules, it can give you, a competitive edge. So I do think, though, it is a love-hate relationship with LOs. They love to be able to get those leads. They also hate it when other lenders get those leads on their own, clients. So it's a love-hate relationship, I think.
Right. Paula, Flea, your thoughts?
When I first heard about it, I thought it was a horrible idea, but oftentimes the first time I hear about anything regarding marketing, I immediately assume it's the worst thing ever. But you have to remember, we also need to have business, and we do need to get loans. But I think, as Jerra, you were saying, our loans and servicing, we want to keep our own borrowers. So we do want a chance, especially in that regard, to keep our borrowers. And, as long as we do it compliantly, it is a way for us to get business. I'm not a huge fan, but probably a necessary.
I give it primarily a thumbs down, only because from the perspective of, weekly you get phone calls from your loan originators, like Jerra said. How is this even legal? And so I actually have a standard script that I send back out to the loan officers that they can talk to their customers about, that this is a person who bought these leads and it was a trigger off of running the credit report or some other factor. And I've told my loan originators to go back and tell that customer, you need to investigate this, you need to shop, but ask them for a loan estimate so that we can compare apples to apples instead of whatever advertising possibly deceptive that they have in that advertisement, because a lot of times it is very deceptive. And so we always school customers to go back and ask for some sort of loan estimate. There's, like California right now, just to ping off of another comment Jerra said, California has pending legislation to license all lead generating services. So, and there's a few other states that are looking into that too. And I think it's a great idea because it would put them in a regulatory framework of which they need monitoring.
And Jerra, you said something along those lines too. You also have your loan officers advise your applicants about the situation too, right?
Well, so again, there's that double-edged sword. You, on your ops and your executive side, you want to be monitoring your own pipeline for potential runoff. But on the LO side, if you want to be proactive, when I was running my branch, one of the things that we would do at the time that the consumer closed is we would have them opt out. And we had, our little spiel that we would talk about, look, now that your deed of trust is going to be recorded, et cetera, you are going to get flooded with offers for everything from life insurance, credit insurance, et cetera. And you'll also be on every other mailing list in the world. You might want to opt out right now from any pre-screened offers. Put yourself on a do not call list. Put yourself, like Marty, like you said, on the direct mail list. Okay, so now we've insulated them, but we might have also insulated ourselves from monitoring that pipeline for runoff. But I do think there's another double-edged sword. If the LO had a great relationship with that borrower, the borrower's probably not going to be as swayed, and is probably going to call them if they want to refi, right? But if they didn't have a phenomenal relationship and they don't call our LO, and then we're doing the trigger monitor, and we call our LO and say, hey, quick, call Flea. She just applied for credit from Wells Fargo. That's kind of creepy. Like they didn't like you enough to come back to you. So I don't know. I think it's probably one of the more, it's easy enough to manage from the compliance side, like you were talking about, Marty, as long as you're doing your correct letters, et cetera, if you're the one making the firm offers. It's a little harder to manage with our LOs who are the quote unquote victims of now the competition side, but it's good to have one where there's not a lot of stressful liability for us. It's more being empathetic with the LOs who hate being shopped against.
Yeah,
it's like you're getting stalked.
Yeah, we are getting stalked.
You are getting stalked, exactly.
It's funny when we have we do loans for our employees, and they'll do an application, and within 24 hours they'll have 15 phone calls from other lenders. I'm like, well, nobody told me this was going to happen, and it's amazing it's amazing. If you're not on the do not call list, if you are not on the opt out, you are flooded with calls and inquiries. So from a consumer standpoint, that is a bit creepy. Absolutely.
So at the end of the day, regardless of the up, the down, I don't know, it depends if it benefits us or not. You really are helping consumers out by giving them fair warning up front that this is about to blow up in your face. And so there are steps you can take to control it.
Yeah.
All right. Lightning round. Item number 3, written list of providers. I'm not going to say the word abuse, but I'm not going to say it either. So the scenario is something like this. LO has an applicant and get the initial disclosures out and lists certain, for example, title companies on the written list of providers, and then working with the consumer chooses another title company. And if you look at the record of this particular LO, you'll see this happens every single time. So there's some issues there. Obviously, the LO is trying to get around the TRID fee tolerance buckets because then you don't have to worry about redisclosure or refunding money or making it difficult for the LO. Not really for the borrower, getting around the law. So what's happening here? I'm going to throw it to all of you. Who's seeing this as an issue and what are you doing about it?
Thankfully, I'm not seeing it as an issue. It's not an easy thing to track, though. I feel like your operations would really need to see it and tell compliance about it. I was thinking we probably could pull reports. There's a lot, we have so much data in our LOS. There's a lot of reports we could pull. So if you could pull something at the initial provider on your written list of providers with your total title fees, and then pull the provider on your CD and the total title fees, you can compare and see if you have a problem. But we do have, we use smart fees up front so that we have quick fees. We get our LE out very quickly. And if we don't have a chosen provider, we default to a company. So in a lot of cases, we may have a company on our written list of providers that we're not using on the CD, but we're not doing it for tolerance, thankfully. Not seeing that issue. The same.
Right. It sounds like you have good controls in place. And I think this might apply to smaller lenders, perhaps the broker community, people who have a lot more independence and can have the freedom to stack the providers list.
We require a fee breakdown from the loan originator when the loan comes in for disclosures. They are required within 24 hours to get a breakdown of the fees from the settlement agent, and we go with that. If at 48 hours they haven't given us that fee breakdown, and we know we're getting up against that time frame to get those disclosures issued, like Paula, we use a third-party vendor. We'll pull in the fees from that third-party vendor and disclose using those fees. But I would say we really, like Paula, we don't have too much of a problem in that area. Our settlement agents that we work with repeatedly are accustomed to our requests. And as soon as that escrow is open, they send over that fee breakdown to us, and we really don't have a huge problem in that area.
So you guys mentioned third-party vendors. I think it really kind of started back with the 2010 GFE, and that was really the first time we were required to provide that service provider list, et cetera, and the tolerances, et cetera. An interesting thing that we found, and this was many years ago, a couple of employers ago, it was that as we got ready to onboard a vendor to provide us those fees, not one provider on the list had ever received an order from the LOs. So they weren't willing to pay the fee to sign up with the vendor. So that was the first time it kind of went off in my head. And when I called a couple of the LOs, they're like, well, why would I list the person I actually use? Then I'm going to be held to tolerance. So God bless them for their transparency and honesty, right? Time to, reboot and talk about it. But I do think that when you have access to these vendors that you can pull fees in from, certainly on a purchase transaction, the lender's rarely, if ever, really controlling that. There are a couple of states where they have more control over who that provider is. It's on the refinance transaction, where we know our LOs have great relationships with title people, with escrow people, and they have those relationships because those providers have worked well for them. They've taken great care. No RESPA issues, not saying there's but then just disclose those people. And this came up at one of our, Flea, I think it was in Boston with the mortgage compliance professionals group. I was surprised by the number of people in the room there at our little pre-meeting or pre-event to the MLS conference or the ARMOR conference who were talking about the fact that they had never really looked at it. And then they went home and they did try to do a comparison of who it was that they were disclosing on their refi, written list of providers, and then who did they actually close with. And they were rarely the same company, but the company they closed with was pretty consistent all the way down. And I will tell you, it is something that was looked at in a California exam.
No, I mean, everything you guys have said, is what we see in our shop as well. It's really, the use of a national provider is not to get away from the tolerances, but really for the timing of the fees and getting an LE out, very quickly. We repeatedly hear from our branches that, oh, well, it can take 2-3 days, especially now during this pandemic, getting fees can take up to that 3-day time frame. So when you're racing that clock, it really does benefit to use a national provider to be able to close the fees. So we've not seen any sort of abuse in that way. I think it is prudent to monitor to the extent that you can with your system to see if, there is any potential abusers out there. But so far, we haven't seen that as something that's happening in our shop. And I do think that use of a national provider as a kind of a backstop, to those local relationships that your branches have, that's a good way to balance the need to be able to get those fees quickly and be able to disclose timely.
Good points. I'm just kind of wondering if anybody's really, if people are really looking for this as an issue, whether the regulators are looking at it as an issue, or whether it's one of those, it could be a TRID violation, a minor TRID violation, or a major one, depending on if your examiner, for example, finds other issues with the company that they want to begin enforcement against you. They're going to find everything, right? So they're going to look for every little detail, and this could be RESPA and it could be UDAP, I suppose. Otherwise, if it seems like you're doing really well in terms of compliance overall and you have good controls for your operation, maybe if that happens, sometimes they don't care so much. Is that a good way of saying it?
I think it was good. And you also have, I think everybody needs to do business in Iowa. You have one agency. So
No offense to Iowa.
If you're under the time gun and you disclose a national provider, that means the borrower was allowed to shop. But if you then choose a local provider, let's say it's on a refinance, the borrower was allowed to shop, but do you then treat that as borrower did shop even when it's our LO or your LO, going back to ABC titles that they always use?
Well, the borrower was allowed to shop, and I think a lot of the times the borrower tells the LO, go with whoever. I don't know title people. Borrowers don't know anyone in title, so they say, whoever you like, whoever's going to work the best on my loan, and so the LO will go with the best company. The borrower was allowed to shop, and I think that's okay.
Yeah, I mean, we go with the same thing. The borrower's allowed to shop. So, at this point, and unless, again, you are able to monitor and, really spot some, abuse, they were allowed to shop. So, you can apply the correct tolerances there. So far in our state exams, federal exams, this has not come up as an issue. So, well, I'm going to knock on wood while I say that.
Yes.
But
Yeah,
okay, no regulators are watching this anyway, so you're safe.
Right.
No, that's great. And it's one of those things that maybe we're paying attention to it, maybe not. Maybe it's a big deal, maybe it's not, but it can be. So I think it's really important to at least have that in your back pocket. Our last issue. Okay, this is a good one, testimonials. And specifically, we're talking about the practice of liking posts on Facebook or any other social media. So at first blush, the obvious answer is, so what? You have an LO and a real estate agent, and they're liking each other's posts on Facebook. So the real estate agent posts a new house for sale in their neighborhood and wants to promote it. LO says, oh, it's a nice house, and I want my followers to see that. I'm gonna like that, and vice versa. So the LO comes up with their LO pitch on Facebook, and the real estate agent said, that's great. So yes, no, maybe. Is that okay? Is that good or is it bad?
Flea, you start.
I honestly feel that it's harmless, but given that, it is not the way that some of the regulators or some of the other practicing attorneys out there refer to it, because they perceive it as a way for the realtor to get free advertising, because when that loan officer likes it, then that like goes out to his group of Facebook attachments. And so the realtor is getting more coverage on that house than they would normally receive through their own Facebook portal. But again, I think it's fairly harmless. All you're doing is giving a thumbs up. I encourage our loan officers to turn the tables on that listing or that like and state, give me a call if you want to get pre-qualified for this home. Or I'm going to be at this open house this weekend, come by so I can see you and we can see what we can do to help you get pre-qualified for this house. So I try and strongly encourage our loan officers to turn it into an advertising for themselves and not so much for the realtor. Now, that mitigates some of the risk. I do understand where the regulators are coming from, but this whole social media forefront and all that Pandora's box that it opens is still yet to be vetted and regulated. And I'm not sure that we can get our arms around a regulatory boundary for any of it.
Right.
Yeah.
And Marty, it looks like there's something on your mind.
Yeah, well, I agree with what Flea's process is, because that's similar to ours. We train our LOs, don't just share it and add your own advertisement. So, hey, if you're interested in financing, give me a call. If you want to get pre-qualified, give me a call. Turn it into your own advertisement so that there's less of a risk of it being seen as a thing of value. And that's more evident. I think the whole liking, how is that going to be tangible in terms of proving that was a thing of value, and how does that equate to a RESPA violation? Not saying that couldn't happen, or 3-5 years from now, somebody might have a case about that. But today, I think it is a bit draconian to think that just liking is a pure, flat-out RESPA violation. I think there's definitely some debate there. But a way to mitigate that, like Flea said, to share that post with your own advertisement so that you can mitigate that. And I think that that's a good way to help.
Right, that's good advice. And Paula and Jerra, before we get to you, the RESPA issue would probably be more of an issue if there is a pre-existing arrangement between the LO and the broker and the real estate broker. So for example, if there's a written agreement between them, an MSA, or it doesn't even have to be under RESPA, it doesn't have to be written, it could just be a course of dealing. If they're always liking and sharing with each other, then you get into the thing of value, at least potentially more. But again, just like in our last conversation, it might be part of a larger course of dealing. So if you as a lender are lacking substantially internal controls and your LOs are doing lots of things that are questionable, then this becomes a bigger issue, right? If however your controls are in place and your LOs are following the laws close enough to satisfy the regulators, that it may not be seen as such an issue.
Well, I wrote down at one of the conferences I attended that they considered the like to be worth $4 to $11. $4 to $11. I don't know where necessarily that comes from, but I thought it was funny and I wrote it down. I am very curious to hear if anyone's had a regulator say something and what they've said about it. I find it difficult to say that it's worth anything. I mean, liking in social media is just a common thing. We like things all the time, even things that are just interesting, or I mean, I may have nothing to do with business. So to always tie it to being a thing of value just because it's a loan officer and a realtor can be a bit excessive, I think.
You could definitely make that argument.
Mm-hmm.
Well, Paula, I was at that same conference. We were probably sitting really close to each other when it was determined that a like on Facebook was worth between $4 and $7 or $4 and $11. And I think that's what I'm really most concerned about. And, you know, Roger, you mentioned the Mortgage Revolution conference last week. And I had the pleasure of sitting on a panel between a social media guru and Richard Horn. And then the other panelist was a top producing LO. And, you know, I just posed the question because I knew it would trigger a little bit of discussion. And the LO's concept was, are you kidding me? A like on Facebook, that's asinine, you know, and I don't want to quote Rich Horn directly, but he said, you know, never put it beyond a regulator to be asinine or something to that effect. And it did lead to a lot of discussion. But it concerns me it concerns me as a compliance officer when I hear, you know, our attorney colleagues, and we rely upon them for guidance and direction, and then they're maybe on a panel at a conference with a regulator, and all of a sudden something that is not actually written in a regulation anywhere becomes the new law of the land against which we're going to be measured, because this is what was discussed. And so, you know, Flea, when we're talking about, or any of you, Marty, Paula, we talk about, okay, so Jerra's going to share a like of Nora Olson's listing. What's that worth? I mean, you know, like all 38 people in my family are going to see that, and my close friends. Does it go much beyond that? And it is how you then use it. And I think, you know, you guys all have phenomenal organizations and phenomenal compliance management going on, and that's really what it's going to boil down to. You know, to borrow from, I think Brian Levy's the one who always says it's the optics, right? It's like, what's the totality of your story? How is it going? Is Jerra only ever liked Nora's listing? And she's not doing much to comment, but she shares it, and she promotes it, and she does whatever, but she is also getting a lot of business from Nora. That's going to look very different from someone just engaged in normal social media behavior, scrolling through the phone, like, you know. And then part of our opportunity as a compliance person to show that we're interested in helping them drive production is doing exactly what Marty and Flea have talked about. It teaches them how to engage and how to use that then to their advantage. Like the post and then make a comment on it, or like the post and say, hey, I'm going to go to this open house on Saturday. I'd love to meet with you there, talk to you about how to finance it, etc. And just make sure that they know what they're doing. Maybe wrap it around co-marketing agreements. Make sure that you codified something in writing with your LO and each, you know, partner that they work with and maybe engaging in social media with, that you're using that to some degree, that you guys have set forth your terms and your conditions there. What kind of tools and resources are you empowering them with? Do you have a marketing system, a marketing operating system? I know a couple of you guys use Total Expert, but, you know, so do they, how are you tracking and monitoring it? But to try to change the way the entire social media world grew up before lenders decided to join in the game and the party, we were late adopters. We got a lot of likes to catching up to. And I just don't see trying to change that as viable or even necessary.
From the lawyer's perspective, because I don't think there's unanimous agreement about the import of this, is it like a purely academic exercise, or is this something that regulators would sink their teeth into? And honestly, at this point, it kind of depends. It's a situational issue. And when you're evaluating your own risk tolerance, you have to keep in mind the benefits to you of doing it versus the potential cost, the litigation risk, the enforcement risk, and make your own determinations. I think that, again, you have to look at the totality of the circumstances. If you have LOs that are running rogue and they're engaging in lots of abuses, this is going to add fuel to the fire, especially if you can show a pattern. And so it's always interesting to know. And I would say at least once everybody listening should at least run an analysis and see what that looks like for their own organization. How prevalent is it? And see if there's patterns. But aside from that, if you're doing everything by the book already, if you're doing a good job of controlling your risk and of being compliant, and this is all that's happening, and it seems to be pretty innocent, yeah, let's just, for operational risk purposes, let's all make a decision. This is not legal advice, by the way. Let's make a decision then, okay, this is something we need to keep in our back pocket. We need to think about it going forward. But I don't think this is our crisis that we have to worry about, especially today during the pandemic. However, if you know that you have other issues and potential loan officer abuses occurring in your organization, it does become more of an important issue, and you do have to put some controls around it and consult your crack legal team to make sure that either you make changes or you put policies in place that you can control it.
Yeah, true. I agree, Roger, that there's definitely something to keep your eye on. But right now, in terms of high risk, medium risk, low risk, in comparison with other things that are going on, it falls into the more low risk. Not something to be ignored. Not something to not have any sort of policy or procedure around, but definitely in terms of monitoring, have something in place, but it doesn't fall into the high risk category, at least in my opinion, at our company today.
So Jerra's heard me speak to this before. We were both co-presented at a Ellie Mae conference on this. I have a separate compliance Facebook account, and I'll go in, and our loan officers need to like me, so that invites me into whatever they're posting. So I can look at them from a perspective to make sure they're putting all the bells and whistle disclaimers in there, but also I can see what they're doing. And I won't chastise them on Facebook. I'll send them an email the next morning if they blew something up. But it also presents an opportunity for you to just periodically go in and monitor. It shows that you're doing your due diligence on your loan originators. You may have a third-party vendor that's also helping you in this area, but it also helps you monitor it. Maybe for an hour a day or less, or you divide up your loan officers to different compliance people depending on your staff. You can all take some time during the day and look at what they're doing and monitor the activities and just see how many likes they're doing. Are they getting repeat business? Is this somebody we have an MSA with, or a desk rental, or we already have some other relationship going on? And it also has an additional benefit, because if they get to where they don't want you following them, it's really awkward if they try and unfriend you. And so most of the time they don't. So.
Well, we use a technology software to monitor, because we have 1,200 loan officers.
Yeah. I just think it would be nuts to think that our LOs can't be engaged in social media, and that they can't be engaged the way that everybody else participating in social media is doing it. I mean, if you're not in social media, you're not going to be in business much longer. That's all there is to it. And as always, I think we just, like you guys have done, and Flea, what you're talking about, you just give them guardrails. And help them stay in those guardrails so they don't go, completely off course. And that should be sufficient. And, maybe if you have a super, super popular LO, the value of that might be $12. And then we'd have to revisit the discussion.
Okay, so regulators, please give them a break.
Yes, please. It's just
You're here.
Well, guys, this has been great. Thanks so much. Want to do this again.
Thanks.
You too. Thanks so much. Everybody stay healthy and stay safe.
Yeah, stay safe.